Over the past 6 months, my hedge fund portfolio outperformed the S&P 500 by 22%. And in this video, I'm going to explain to you exactly how we did it. Now, for those of you who do not know who I am, my name is Stephen Brooks. I'm a hedge fund manager who specializes in systematic options, specifically on the S&P 500 index. Now, in my opinion, there are only two ways to make money consistently over the long run in financial markets. They are the buy and hold model or harvesting what is known as the variance risk premium. Now, we're going to start with the buy and hold model because that is the quickest to explain and also the one that most individuals have heard of before. You buy a stock, you buy an ETF, you buy an index, you buy a mutual fund, and you don't sell it. You hold on to it. And that will work in my opinion because inflation grows at 4 to 5% per year. GDP is 1 to 2% per year. That gets you your 6 to 8% annualized returns, which are the exact annualized returns of the S&P 500 index over the past century. Now, odds favor something like that continuing into the future. Of course, there's no guarantees of anything, but odds are going to favor inflation continuing to grow at that rate, GDP continuing to grow at that rate, and the money supply also increasing. So the buy and hold approach, getting those 6 to 8% annualized returns, that's probably something that's going to continue in the future over the long run. Now, if you want to maximize your performance within that buy and hold model, Fidelity did a study a few years ago where they looked at their top performing accounts and noticed three things that were similar between all of those accounts. Number one, the account holder was dead. Number two, there were automatic deposits and reinvestments made each month. And number three, the account automatically reinvested the dividends. So if you are interested in that long-term buy and hold approach and are looking to maximize it, well, here's how you do it according to Fidelity. Number one, find a low-cost index fund and buy it. Step two, set up automatic deposits from your bank account into your portfolio where those deposits trigger an automatic buy of that low-cost index fund once or twice a month. And then step three, go to that low-cost index fund in your brokerage and set up automatic reinvestments of the dividends so that instead of getting cash, you're automatically repurchasing more shares of that index fund. If you do this, and it should take you less than an hour to set up, it will give you the absolute maximum performance of the buy and hold model according to Fidelity. So for those who are looking to build up a really nice large nest egg over time, this is something that takes less than an hour to set up once and will allow you, unless something dramatically changes in the world, to build up a very nice nest egg that grows and compounds over many decades at a pretty nice rate. Now, if you are interested in either the potential for much greater returns than the buy and hold model can offer, if you're interested in much faster and much more rapid compounding of your portfolio, and if you are interested in the portfolio feeling like an asset that pays you cash on a relatively frequent basis, then you'll want to pay attention to the next part, because this is the route I chose myself, and this is the route we go down in our fund that has gotten those incredible results that we showed you previously. And that is attacking what is known as the variance risk premium. Now, the variance risk premium sounds like something that is overly complicated, but it is embedded into the market. Think of it like selling insurance. When people are nervous about the stock market, they're willing to pay extra money to protect themselves, just like you pay for car insurance, even if you've never gotten into an accident. We are on the other side of that trade. We are the insurance company. And just like an insurance company, we collect those premiums every single day. That is the variance risk premium. And it is the single most reliable embedded edge in financial markets. It's been there since day one. And unless individuals do not want to protect themselves in the future, it is very likely to continue. So here's an example. Let's say a large fund owns $100 million worth of Apple and they want to insure their position. We will offer them that insurance. Now, because we take on more risk than they do, we get a markup for that service. Or on the other hand, if a hedge fund is short a large amount of money in an individual stock, GameStop maybe, they may want to insure that position as well. We will sell them that insurance, of course, with a markup for our service, because we take on more risk than they do. And instead of just doing that, once or twice every now and again, we do that 30, 40, 50, and even sometimes upwards of 100 times in a given day, allowing us to spread out our risk, but create enough occurrences where we are able to, in many cases, pull forward and realize that edge that we have, that markup to the same day. That's very important. Now, let's talk about how we have constructed a portfolio that has outperformed the market by 22% over the past 6 months. First, we start with a single strategy. That single strategy must be based on an embedded edge in the market, meaning we cannot try to make it up. The reason to enter the strategy can have at the very most one filter, and it must come with a relatively high frequency so that we are confident in the statistical significance of the data that we're basing our decisions on. Here's an example. There are circuit breakers in the market that were added after the crash of 1987. If the market goes down certain levels in a short amount of time, the circuit breakers will kick on so that the market cannot go lower for a 15-minute period, depending on the time of day. Those circuit breakers turn off at 3:25 every single day. So the final 35 minutes of the trading day, those circuit breakers that are there to protect the market against catastrophic losses are off. So it stands to reason from a logical sense that if we are selling insurance before 3:25, the markup we might get may not be as big as if we sell it after 3:25, simply because the extra protection already embedded into the market before 3:25, the circuit breakers are no longer there. We did not make that up. That was added in 1987 and is still there today. That is what I call an embedded edge. Now, the filter for this strategy is simple. The clock has turned to 3:25 in the afternoon. That is it. No moving averages, no concern for what the market has done previously for the day, no concern of the movement and volatility for the day. All we care about is if the clock has turned from 3:24 to 3:25. And it does come with a relatively high frequency, right? This is a trade that happens at the same time every single day, rain or shine. It happens when stocks are going up. It happens when stocks are going down. It happens on FOMC days. It happens on non-farm payroll days. It happens every single day, unless we get a holiday where the market closes at 1. Now, to us, something that essentially happens every single day is enough statistical significance to be able to project the model moving forward within reason. Next, we take our real world costs, meaning the commissions to enter the trade, the commissions to exit the trade, as well as the slippage to enter and exit. We do that accurately, and in many cases, we overstate it. Then we run it through our own internal software and test many different strategies around that edge. Our software will automatically test hundreds of different strategy variations. It'll test condors, short calls, short puts, call spreads, put spreads, ratio spreads, and more, all with a varying profit target and varying stop loss. Then it outputs the data set, and we look for consistent ranges of profitability. When we do run these back tests, we first run them on in-sample data. For example, we're currently at the end of March 2026, and we could have good data going back from January 1, 2020 until today. When we run our first round of back testing, we might run it on data from January 1, 2020 through the end of 2023. We want to see that it works and the model that the strategy is based on that data set. Once we confirm that, we then run it in what is known as out of sample data, meaning data that was not used to build the model, right? In this example, we've built the model based on 2020 until the end of 2023, and then we want to make sure that it works in data that we did not model off of. If we can take something that was modeled on 2020 through the end of 2023 data and then give it completely separate data, like 2024 to present, that is what we never trained it on. And if it still works there, that is a very good indication of the strategy's robustness. What we are looking for is consistent ranges of profitability. For example, if selling an out-of-the-money put right at 325 appears to be ineffective with a stop loss of 10, 20, 30, 40, 50, 60, and 70%, and then all of a sudden it becomes profitable at 80, 90, 100, all the way up to 300%, and then starts to trail off after that, we have found a strategy with a very large range of settings that historically have been able to capture a percentage of that embedded edge. That wide bucket of profitability tells us this is not a coincidence and instead is evidence of the edge. If we find a range that is successful with multiple different variations of the same strategy, and it works both in sample and out of sample data, we also run a Kelly test, a regression test, and Monte Carlo simulations, but those are a topic for another video. But we have something that is effective around all that. The odds of it being successful into the future are very high, and we essentially add it straight to the portfolio. Now, once strategy 1, or A, is added to the portfolio, the next thing we do is automate it. Look, it's great not to have to physically click the button yourself, but when we automate it, we are removing a lot of the executional risk that comes from manual intervention. We want to do something right at a certain time, and an automated system is going to do that accurately every time. A human might, talk themselves out of it, might look at the market and think, oh, this should not be the day I do this trade. Might be a little bit slow, might click the wrong button. We're looking to collect the expected value of the trade, and an automated system, a machine, an algorithm, is going to be able to collect a far greater percentage of that expected value compared to a human. For example, a bot might be able to consistently collect $18 out of a $20 expected value, where a human is going to be able to collect something like $10 out of $20 of expected value. Now, once we have our edges identified, validated, and automated, the goal is simple. We spam bet those edges. We do not trade them every so often. We literally spam bet them. We trade them every single day, as many times as the strategy allows, because the more occurrences we create, the more we move from variance to certainty. This is how 30 to 50 trades per day becomes the vehicle that delivers what the model projects. Now, that's one strategy. The goal is to find 6 to 10 of these. Anything more than that starts to become overkill. Anything less than that increases your odds of experiencing a pretty substantial drawdown at the portfolio level, which is the whole point of having a portfolio in the first place. So we go through the exact same process for each individual strategy. Do we have an embedded edge? Does it make sense? Is it not overfitted? Does it work in in-sample data? Does it work in out-of-sample data? Do we have regression tests, Kelly tests, and Monte Carlo simulations? Have we found a consistent range of profitability? Does it even make sense in the first place? Now, once we have confirmed all of that, we then take the actual trades from the model and compare them to the trades already in the portfolio. Because what we do not want to do is have 2 trades that are essentially the same, meaning we do not want strategies that are successful on the same day and unsuccessful on the same day together. So we run a correlation study. A correlation study will compare the results of two strategies and give you a number between plus or minus 1. The closer to 1, the more correlated they are, meaning they win and lose together. The closer to -1, when one wins, the other loses. We want it to be as close to 0 as possible. For our fund, we want to make sure we are within plus or minus 0.25 when it comes to correlation. And look, if the correlation is too high, that's okay. You basically have to pick the best one from the bucket and then keep on moving forward. And what happens is you arrive at 6 to 10 strategies, all taking advantage of embedded edges, all modeled based on real-world costs, all tested in sample and out of sample, all tested with Monte Carlo simulations and regression tests, all of them working even if you change things like the profit target, the stop loss, or the timing of the trade, and none of them highly correlated to the next. And that is all automated so that you can collect a high percentage of the expected value you're hoping to collect. That is a portfolio. That is how we have done it at our hedge fund. Based on the expected values of those trades, the correlation between them, and all of our modeling outside in-sample and out-of-sample data and Monte Carlo simulations, we are shooting in the portfolio for a 40% annualized return. And according to our Monte Carlo simulations, we have a 95% confidence interval of landing between 20% and 40% in a given day, which is interesting because over the past 6 months, we have a 19% return, and that gets you directly in line with those expectations. Now, that is a combination of rigorous testing, rigorous analysis, understanding where these edges are, understanding how they exist, understanding the correlation between one another, and ultimately finding methodologies where you can increase the number of occurrences so that it moves from a guessing game to a probability game. Now, of course, there's going to be variance, right? January was a down month for us, but it's not really a big surprise that the results over the past 6 months have essentially come directly in line with the expectations. When you model everything properly, when you test it at many different levels, and you do it based on edges that are embedded in the market, and you're not overfitting anything, you will be surprised just how accurate the results are compared to the model. And that is what our fund does. And those are the results. And this is how we have arrived at those results. It is obviously pretty complex and requires a good amount of understanding of math, statistics, and of course markets to be able to understand what is an embedded edge versus one that we're making up, how to structure strategies that can collect a percentage of that edge, the automation process, and building a portfolio that is not correlated to itself. That obviously takes a lot of real-world experience, a lot of knowledge, and a lot of clear, level-headed thinking to have something you modeled essentially line up with what's happening in the real world. So, if you liked what you saw here, there are 2 paths that you can take. Number 1, if you are an accredited investor and you want to invest in our fund, there will be a link below this video where you can go ahead and express interest. If you are not yet accredited and you want to learn how to find some of these edges yourself and use our software to automatically place these trades on your behalf so you can collect as big of a percentage of the available edge as possible, there will also be a link below this video for you as well.